What's up, everyone? It's Caddy with Money Investing. Welcome on board for the event, for the big event that is going to be Jerome Powell's speech. And of course, the report that comes out in about 28 minutes. So, exactly 28 minutes, we're going to find out exactly how much rate hike we're getting, whether it's 50, 75, or 1. And then, of course, in about an hour's time, we're going to hear from Jerome Powell live. If the audio and the video is working well, I just want to make sure that everything is working well. So just give me a thumbs up in the live chat, and we should be all set and all good to go. So again, just give me a thumbs up, and we are ready. We are good to go here. Perfect. So I'm gonna do a poll. I'm gonna do a poll going. We're gonna ask for whether Jerome Powell is gonna do 50, 75, or 1%. Right? That's gonna be the poll here. So Jerome Powell, well, let's just do the rate hike today. 50 basis points, we got 75 basis points, and we got full 100 basis points. That's going to be 1 percentage point. So we've got something for everybody. Everything's on the menu. So choose whatever you think is appropriate or what the Federal Reserve is going to do in about 28 minutes here. So it should be fun. We are ready. So let's do it. So NASDAQ is down 1%. So we have just been selling off since the market opened. We've just been selling off here. So we've pretty much shed over 400 points on the NASDAQ. The S&P's pretty much dropped a little bit over 60 basis points since it's opened. The Dow has been relatively flat. It actually opened lower and then it started to push higher. It is actually higher than where it opened at. So it's up over 93 points from where it opened. Mostly it's been technology stocks, so mostly tech-oriented names. I mean, Google's down over 1% now, under $90 per share, hitting a new 52-week low. Tesla's down over 2.5%. We got AMD pretty much giving up on all the gains, which is something that I also mentioned in my AMD video that, I wouldn't be surprised if intraday AMD starts to sell off after the earnings because, well, there was no reason for AMD to be up 4 or 5%. Sure, they had a big share buyback program, but earnings miss, revenue miss, and a lower guide as well. So we are seeing some profit taking here. Apple is also down about 1%, so dragging on the overall market. And then, of course, Meta hitting a new 52-week low, Google hitting a new 52-week low, and then Amazon also hitting a new 52-week low. So we got some big tech companies here just pretty much selling off, with the 10-year yield is just stabilized at over 4% right now. So I'm going to be coming over to the chat here because I don't have access to the chat separately because usually I do have an external monitor. Right now I don't, so I'm going to be coming back and forth to the chat to kind of respond to some of the questions and comments and some of the jokes here. So Steve is pub drunk already. We're only just getting started, man. Come on, you gotta pregame a little bit, and then when Jerome Powell starts talking, that's when you start gulping as the markets are selling off. But anyway, so hope you're having a good time. But yeah, so we've got about 25 minutes for the Federal Reserve to release their statement, and the first thing we're gonna do is we're gonna simply come over here. This is the Federal Reserve's website. And right at 2 p.m. Eastern, I'm going to reload this page, just like we did last time. It was pretty exciting, right? So I kept reloading it once, twice, 3 times, 4, 5, 6. And then finally, boom, you've got the report right here, the statement. You click on that PDF, and we're going to find out the interest rate hike that the Federal Reserve did. And then, of course, the market's going to move pretty dramatically. In my view, if they do 75 basis points, I think that's pretty priced in. It's at this point, I mean, if you take a look at this FedWatch tool, 88% probability for 75. So it's pretty much locked in at this point. I don't think it's going to come as a surprise for the markets. Anything but is definitely going to be a surprise, right? If you do 50, if you do 1%, that's going to be a big surprise for the market. And right now, of course, we're waiting for this to start in about an hour's time. But Kellen says we should play a drinking game. Every time Powell mentions inflation, we take a drink. Yeah, I mean, go for it. Go for it. If you guys are interested, absolutely go for it. Obviously, the drink doesn't have to be alcoholic. It could be anything. It could be a shot of coffee or something, water, whatever works for you. But right now, we've got 77% of people expecting 75 basis points. That's pretty much in line with what we have for the FedWatch tool, right? So you can see how we collectively also represent a small data set of the market overall, and we are pretty much in line with what the expectations are. It's a little bit more spread out because I've got one more option there, which is 50 basis points. 14% are very, very dovish, expecting 50 basis points. And then, of course, 9% are really hawkish, expecting a full 1 percentage point increase. And then, of course, 77% are pretty much in line with what the market's also expecting. So Should be fun. Definitely should be interesting. The markets are, it's good that markets are selling off prior to the meeting, because that could lead to some momentum to the upside. Because as I said before, and as we talked about in our Market Open live stream, that every time Jerome Powell has spoken, in the last four, I think, FOMC meetings, the markets have rallied after his speech. They have sold off on the report, but then they have rallied when he started talking. So a few takeaways, few things to watch out for. A hawkish Fed is all going to be about another unusually rate increase of 75 basis points, could be appropriate. Inflation is sticky, it's entrenched in the economy. People's expectation of inflation are pretty high. Anything along those lines is going to be pretty hawkish, but anything along the lines of over tightening or pausing or slowing down is going to be pretty dovish. So I think that's really what's going to move the market. It's not so much the 75 in my opinion. So, all right, let's see here. Powell opening statement. Yep, so it's going to be very, very interesting. I have my Red Bull here. Perfect, Mohammed. That's awesome. That's a great drink. And yeah, we're ready. A lot of stocks are also selling off, especially on the tech sector. So again, tech has mostly been under a lot of pressure. So most of our updates when we've done like our analysis on FinViz, there's been a lot of selling towards the top left of the screen, right? So you've noticed that mostly Amazon, Google, Meta, Microsoft, Apple to some extent have been at the bulk of this selling pressure, which obviously is driving the markets lower. So if you take a look at the last 1 week, you'll notice it's pretty clear, right? It's very apparent which names have been selling off, right? It's the big tech, right? It's the FANG. This is the last 1 week's performance, and take a look at how much Microsoft's been down. Google's down 13% in the last 1 week. Of course, Meta's down 30% because of the earnings. Amazon's pretty up there too, like down 19% in the last 1 week, and Tesla's been holding up pretty well. But I think it is down over the last 1 month. So it's down over 6% because they also reported earnings, not this past week, not last week, but the week before that. Mostly it's been the companies that are reporting earnings, and since the expectations for these companies have been so sky high, that if they come in, a little bit shy of expectations, weaker guidance because of the economic challenges and the stronger dollar and higher rates, they obviously get affected pretty badly. And that's what we're seeing, a little bit of a valuation reset, because if you come over to the forward P multiples, a lot of these companies are now just like at insane levels, right? Google at 16. Can you believe that? Meta's under 10 right now. Google's at 16. AMD's come down to 15.4. Like, you gotta be absolutely kidding me with these valuations for a lot of these companies. So let's see. Amazon, 20%. Yeah, pretty brutal. Definitely been selling off quite a bit. Waiting to see red or green after 3 p.m. Venka, that's a great question. Really, it's a difficult one to answer. Really, I think it's all going to depend on the tone at which Federal Reserve, pretty much Jerome Powell talks, right? During the Q&A and during his speech as well, right? The speech is going to be for the first 15 minutes, and then the Q&A is going to be for the next 30 minutes. Sometimes these Q&A last longer, sometimes shorter, but on average, these last about 45 minutes. So in about 20 minutes, we're going to get the report. We're going to see how the markets react to that. And then in 30 minutes later, at 2:30 p.m. Eastern, we're going to get that Jerome Powell speech. So really, it's anybody's guess at this point, what that tone is going to look like. Knowing Jerome Powell, and somebody shared the entire open letter that Jerome Powell received. I'm actually going to do a video on that as well. I don't think that's going to make a big impact, a big influence on Jerome Powell. If it does, I'll really be surprised because, well, I guess in the past he has talked about certain things and then walked back. So maybe that may not be as much of a surprise. But he has mentioned that, he doesn't take into account any of the, political influence that he might get or is getting from any of the parties, right? So that's not into consideration because monetary policy is an independent authority like the FOMC. They're supposed to make decisions irrespective of who's in charge or who's in office, right? So I don't think that's going to play a bigger role, but if it does, well, that's politics. What time are the numbers coming in? So 2 p.m. Eastern, so in about 18 minutes, the numbers are going to be coming out. We're getting a little bit of a spike already, right? So Google is already starting to see some green candles come in. Apple's been pushing higher, so we have seen Apple push up a little bit over 0.5% here, and then AMD still pretty flat, but Apple and Google are starting to see a little bit of a spike here to the upside, and so is Microsoft. You see those green candles coming in? Right now, there is some momentum to the upside. Let's see if there's an uptick in volume too. So no, it's not a lot of volume though. Like it's trading on relatively low volume still, but we are seeing a little bit of a move to the upside for these big tech companies. Let me see if I can copy the volume here. Yeah, a little bit lower volume for Apple too. So not a lot of movement in volume, but of course, definitely the price is moving up. Microsoft's breaking outside its middle VWAP for the first time intraday, and I think so is Google. Yeah, Google's kind of testing its middle VWAP right now. So you see that middle VWAP, that's trading at 89.77. It's been mostly trading between the middle and the lower VWAP intraday, then started trading sideways, and right now we're seeing a little bit of a retest to see whether we get a breakout above that level. All right, and another thing I wanted to mention, which is I think is going to be suppressed a little bit under the FOMC minutes or FOMC meeting, is going to be the Bank of England. So they're also going to be raising rates tomorrow, and they are going to be doing it the most rate hikes in over 33 years to tame over 10% of inflation. So they've got a bigger problem as well. A much bigger problem than what it is in the US, and I think that's also going to move the gilts. That's going to be a bigger impact on, of course, the UK market as well. The gilts have been moving lower as we've seen a little bit more calmness, more stability in the UK market with a new prime minister and, of course, a new finance minister, and as we have seen the pension funds kind of deleverage and de-risk a little bit. So that's good. We've seen a little bit of a trailer of what an implosion might look like in the finance and the banking industry in the UK, and that didn't happen. So that's good, of course, from a contagion risk standpoint. But yields coming down, that's a good thing. So again, tomorrow Bank of England is also scheduled to raise rates, probably by another 50 or 75 basis points. All right, so 75% expecting the markets, the Federal Reserve to pretty much raise rates by 75 basis points. So which VWAPs are you using and what settings? So it's pretty much the regular volume weighted average price. So again, the default values haven't really changed anything, and it's just the VWAP standard bands that I'm using on TradingView. And I've done a complete tutorial, like a complete detailed lecture on this, and how it's used, why it's used. VWAPs are actually utilized by hedge funds as well. This is one of the few rare indicators that hedge funds actually use when they're doing technical analysis, and they don't actually use like the upper and lower bands. They mostly just use the actual VWAP, which is just the yellow line you see, and that's telling you the volume weighted average price. A little bit different than the simple moving average or the exponential moving average. Very, very useful, and this only applies to intraday, like only 5 minute, 1 minute, 30-minute charts. You can't look at the VWAP on a daily candle or on a weekly candle. It just doesn't work that way because, and of course, it doesn't work on any foreign exchange or any of those things, which doesn't have a volume for every trade that's going through. So, very, very useful indicator. So I see a lot of people talking about Meta. Let's see. The bull caddy will turn the things around. Yes, I actually did. Did that as a fun thing. Of course, in Italy is a symbol of Italy, that the bull, and you kind of stand on it, spin 3 times, make a wish. And I was told again, it's going to happen in the right circumstances. So it's not like it's going to happen right away, but when the circumstances are right, when it's supposed to happen, it'll happen. And I think that just speaks to me that we got to be patient, right? It's not going to happen overnight. The markets are still under a lot of pressure, under a lot of stress. And I just wished, for the well-being, for having a good year for all of us, for our community in 2023, irrespective of whether it's in the market or outside of the markets, just having a good year, just a much better year than what 2022 has been like. All right, Steve says Meta's doomed, wake up. So I don't know why he thinks that. I would love to know his thesis, but plenty of free cash flow, positive earnings, still a profitable company, balance sheet's very, very solid, liquid, more cash than debt on the balance sheet, and then investing in something that's going to be the future. I don't see why that might be doomed, but okay. I felt like you performed perfectly on your spins, bull market incoming because Kendall says, yeah, so hopefully we'll see what ends up happening, right? So, your take on Coinbase earnings today. So Coinbase, I think, is scheduled to report later after the markets close, if I'm not mistaken. So they are actually, I think they're tomorrow. Okay, so tomorrow is when they are expected to report. Negative $2.37, 640 million in revenue expected. And really the issue is with Coinbase is if Bitcoin obviously sells off or stays pretty stagnant, if it's not a lot of, there's not a lot of trading volume for Bitcoin, then unfortunately Coinbase is not going to make any money, right? Coinbase makes money on transactions. They want people to transact, buy and sell cryptos as much as possible so that they can actually make money off of fees. And they usually the trading activity picks up when the crypto is going higher. So usually in bull markets, Coinbase's revenues and profits pretty much accelerated substantially. As opposed to in bear markets when Bitcoin's selling off like 60-70%. So it's been mostly stagnant. If you take a look at where we were in June versus where we are now, it's been mostly sideways. So we could see a flat year for Coinbase from a year-over-year perspective. Like this quarter might still come in a little bit lower from a revenue perspective. So 640 million is the expectation, and this is for the September quarter. So if you come back to what they reported last September, which was 1.6 billion, right? So that's actually 1.3 billion. So it's a 50% decline in revenue, and they also reported positive EPS versus the expectations, which is negative. So we are seeing declines in earnings and revenue, and a lot of it for a lot of companies, just given what environment we're in. So, all right, let's see here. 75% for 75 basis points. Yes, that's what it is. That's what the consensus is right now. So market wants to rally. If he's dovish, the market will be up 10% by the end of the week. My guess, he's hawkish. So yeah, it really depends on what the tone is going to be for Jerome Powell, right? What he ends up talking about. And thoughts on Roku. I'll do a separate video on Roku as well. We're kind of closing in on the time here. So we got about 11 minutes left for the report to come out. So I'm going to prepare everybody, kind of give you guys a recap and what we're looking for. The Dow is definitely pushing higher. It's now green. So big green candle coming in for the Dow. I'm assuming on the back of Apple and I think Microsoft as well. I think both of these companies that we were just looking at got some big jumps. So you can see how Microsoft had a very nice string of green candles, and then Apple also pushing higher, and that's as a result putting a little bit of an upwards pressure on the Dow Jones right now. So you'll notice that Apple and of course Microsoft are kind of still red, but not as much as what they were just a few minutes ago. And of course, Boeing and Verizon and Dow Chemicals and Merck and Walgreens, they're the ones kind of really driving this potential move to the upside for the Dow. Now again, Dow is price weighted, so Apple does not make as much of an influence on the Dow index as McDonald's does, or Travelers does, or UNH does, because again, they have higher price stocks as opposed to Apple, which is trading in the 140s and 150s. So yeah, it's a little bit of a different structure for the Dow Jones, and Apple is not the big dog in the Dow. It's mostly it's UNH and the likes of McDonald's and some of these other companies like Amgen and Caterpillar and stuff. Nasdaq still down 75 basis points. S&Ps are down about 24, and we're ready. We are going to reset this page, refresh in about 9 minutes. And of course, this obviously will start very soon too. All right. Summer stock, are you planning to add to your Google position? What is your price you're waiting for? So yes, I have a cash secured put on Google, right? So at close to $91, I have a cash secured put. So right now I'm already in the money for Google because it's trading at. Where is it trading at? So Google is at 89.90, right? So closer to $90. So right now it's already in the money, and expires I think at the end of November. So if it expires in the money, then obviously I'll get assigned 100 shares at $91. So that way I can dollar cost average a little bit. So he's gonna do his best to thread a tone where he's neither. He's gonna say the word monitor a lot. Powell usually pretty careful with saying anything super bad. Yeah, I think that's really true. I think if there's one comparison I think if there's one comparison that we can draw between Andrew Bailey of England and Jerome Powell, and that is that Jerome Powell is actually not as straightforward as Andrew Bailey, right? Andrew Bailey is a very, very sort of straight shooter. He'll tell you what he's thinking. He'll tell you what the analysis is. He'll literally just give it to you, as real as possible. Jerome Powell always likes to kind of, thread that right balance. Because he doesn't want to spook the markets, but he also don't want everybody to start anticipating a pivot. So he has to kind of work that fine line, which is just a different way of communicating, right? If you were always trying and to pretty much be very straightforward and talk about, what the realistic picture is, well, the markets would not be where they are. They would be much lower, and he would be getting a lot of political pressure. Like, he would be getting even more. Like, imagine the amount of criticism and the hate that he gets, just 10x it even more. Like, if you were like actually talking, very, very straightforward, like in a very real way. But at the same time, he's got to make sure that he doesn't kind of comes off as very dovish, so that the market starts anticipating and starts pushing higher, only to get disappointed later. But the market just does that anyway. So I think that's been a very, very different approach from Jerome Powell versus Andrew Bailey from England. And yes, he's cryptic. I think Kevin's right. He's very cryptic. Talks in a lot of vague sort of statements, and you got to make out, exactly what he's talking about. So, all right. So, okay, make sure that you guys drop a like. We're at 74 likes, but over 700 people watching, so we can at least get up to over 500 likes easily. Just tap that like button. I would really appreciate it. And we are all set and ready to go in under 6 minutes. The report comes out, and we'll see the market's reaction live. We'll see how the NASDAQ does. We'll see how the Dow Jones and the yields and the volatility and cryptos and oil and pretty much a lot of different markets are going to be moving on that rate hike. So yeah, that's going to be it in under 6 minutes. Honestly, it's so exciting. It always is, isn't it? Like, the Fed meeting is always exciting. It's always a good time. Fun to watch. Fun to really pay attention and participate. So, any thoughts on LABU? So, all right, let's take a look. So LABU really, depends on where, I forgot what the name, XBI trades. So that's the biotech ETF, right? So pushing up over 10 basis points right now. It's been mostly consolidating sideways. So after the sell-off that we got, about 18 and 19%. Sorry if you guys can hear the siren in the background. It's just like, I have the window open because it's like really hot in here. I had to crack open the window, so I do apologize, the siren's loud. I thought I was out of New York. What's going on here? Like, these types of noises just like still pretty apparent in freaking Turin, Italy. But if it's too loud, I'm definitely gonna shut the window. It's fine. I'll just wait a couple seconds here. This is probably the ambulance coming for the market later. I think the ambulance is getting ready for the market, or what's about to happen. I don't know. But as I was saying, biotech here, mostly consolidating sideways. You really have resistance all the way up to $95, $97. That's where the 300 estimate is. And support level is going to stay put at $75, $76, right? So this is going to be that level to watch as a support for biotech, and of course resistance all the way up to $95, $97 per share. Celebrating the crash. So Steve, okay, so your main thesis really is all about the metaverse spend. Then really there's no thesis there, because every company's been spending money on metaverse. Meta just happens to be the company that's spending a lot more. Apple is spending money on it. Google is spending money on it. Microsoft is spending money on it. Every single company that wants to be at the cutting edge of this new technology, which is going to have a use case, may not be as mainstream as what people like to believe, but it is going to have a use case. If that were the case, why would Apple be spending money on it as well? Like, they're going to unveil something in the metaverse next year. At least that's what the expectation is. So if there's no market there, why would every company be spending money? Billions of dollars. Meta just happens to be the company that's spending the most, and they're burning through a lot of cash. So, and they're also spending on AI. So, I mean, they're investing, they're not spending. That's the thing. There's a difference there. They're not spending money. It's not like they're just burning cash. They're just not seeing the return right now. It's just an investment into the future. If it works out, great. If it doesn't, well, their core business is still strong and their risk reward remains compelling. So those are my thoughts there. Can't compare Apple to Meta. You watch until how big of a battle this becomes between a lot of these companies when they start competing against each other. This is nothing. I mean, this is only the beginning of what they're doing and where the technology is going. Like, you wait 5 years, 10 years, I'm sure you'll come back and realize like all these companies are going to compete against each other. I bet Microsoft, Amazon, Apple, like I bet the cloud business between Microsoft, Google, and Amazon's only going to get really, really fierce. Like in 5 years' time, these companies are going to be at their necks for the cloud business. AWS, Google Cloud, and Azure. There's going to be an insane battle in the cloud business. And then same thing with Meta and Apple for the hardware business, and same thing with software and metaverse as well. All right, so we got a little bit over 2 minutes, under 2 minutes, folks, 2 minutes. We are ready to go. I'm going to switch over to the 5-minute charts here just to see the market's reaction. So right now we're just a little bit under 10,800. So that's where we are. And then we've got the S&P 500, also 5-minute chart, just a little bit over 3840. And the Dow Jones still positive, barely though, still up over 39 points right now. Let us do this. Let's see what this rate hike is going to look like. Again, I'm going to reload this page in exactly a minute 30 now. It's going to take some time to load up. So what we're really waiting for is the first thing I want to look for is the rate right here, the Federal Reserve's rate hike. Right now it's at 3.75%. And a 75 basis point would mean that we get up to 3.75 to 4%. So if you see the number 3.75 to 4% here, that means the Federal Reserve raised rates by 75 basis points. All right, in under a minute, folks, under a minute. All right, I'm gonna, all right, let's do this. I wish I had like a countdown clock here or something. All right, so we got in New York, we got 15 more seconds. Ten seconds. All right, so we're gonna reload this in 5, 4, 3, 2, 1. Let's do this. All right, let's see what we got. Oh, nothing yet. Nothing. Yeah, usually takes a lot of time. Usually takes a few seconds to load up. Is the market moving? Not so much. There we go. All right, we got the statement. We are looking at 3.25% and 4%. There we go. So 75 basis points it was. So the Federal Reserve did raise rates by 75 basis points because now the federal funds rate is sitting at 3.75% to 4%. And they pretty much mentioned that ongoing increases in the target range will be appropriate in order to attain stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. The markets are rallying on this news. So we've got the NASDAQ almost green. The S&P 500 is up over 13 basis points, and we got the Dow Jones rallying over 178 points, up over 0.5%. So again, 75 basis points is what we got. Pretty standard statement. Nothing's going to be changed on the other sort of things. So we're going to just have to wait for what the Federal Reserve ends up saying. So Jerome Powell is going to be due to speak in about 30 minutes. But the real key here was, again, that 75 basis points. That's exactly what we got. That was pretty much the consensus here. That was the consensus among our investors as well. Over 632 votes, and boom, 75 basis points it is from the Federal Reserve. Now, really what's interesting is the last 4 FOMC meetings, the markets have dropped on the report and rallied on the speech. And right now we're seeing a little bit of a rally on the report. We'll find out what happens during the speech. But S&P is up over 0.5% now. NASDAQ's just pushing up 26 basis points. Lots of individual stocks. So Apple here up 40 basis points. Tesla back up to 229, so green now. And AMD also up almost 4%, with Google, which was down to $89 a share, is now green, also pushing up over 65 basis points. So big green candles coming in for the markets, can we get some green hearts in the live chat for the green candles that are coming in? So just post some green candles so we can kind of kind of celebrate the green candles that we're getting. But of course, obviously it depends on what Jerome Powell ends up saying in about 30 minutes or so. But 75 basis points was done for the Federal Reserve. So now we're sitting at 3.75 to 4%. So if you come over to the Fed funds rate, again, I want to show you where we are with respect to where we've been over the last several years. This thing wasn't loading up before. So if you take a look at where we were back in 2019, 2.38%. So we're way past that level, right? We're like, that level is just like a dot to us now. If you come back to where we were back in 07, we were at over 5%. So right now, since we're at 4%, we are going to be at closer to a level compared to December of 2000. Actually, call it January of 2008. So this is where we are with the current rate, because after today's rate hike, we're going to be sitting at 4%. So this is where we are, and it's comparable to where we were in January of 08. So just a little bit of perspective there, how high we've been going, how fast we've been going, by the way, because these rate hikes over here happened in a span of, can anybody guess? Very easy question. In a span of how many years did those rate hikes go up? How many years did it take for the Federal Reserve to raise rates back in 2005, 2004? Two years. 2 years, right? 2 years. 2 years we went from about 0%, pretty much, a level which was at around 1% to as much as 5%, right? So we went from 1 to 5 in 2 years. This year we went from 0 to 4 in 9 months, right? So we went the same amount in half the time, right? So that just goes to show how aggressive this Federal Reserve is, to put things a little bit in perspective there. So yeah, we're definitely seeing some big candles coming in on the 1 minute chart. You can see it a little bit better for lots of these stocks, and of course for the indices, and the yields are dropping. So the yields are down 1.5%. Volatility is also down 19 basis points. Crude oil, however, is pushing higher. So it's up over 1.85%, back over $90 a barrel, which is not a good thing. It's getting up to that resistance of $90 a barrel again. So that is going to be that next resistance. And in the month of November alone, and this is like November 2nd, it's like literally the second day of November, and crude oil is up over 4% for this month. So definitely something to pay attention to from an inflation standpoint, because this is a big leading indicator for where oil could be in the future. All right, let's see here. So, all right, 2 years, yep, so perfect. Yields are moving. US 10 years back under 4%, yep, so we just checked that out. Of course, Meta is still in red, but it is still coming off of a pretty brutal red day, of course, kind of starting to push higher, and so is Tesla, right? Tesla's still coming off of a very, very red day and starting to push higher, so both of them are kind of struggling at the moment, and then, of course, we got Netflix, Amazon, still trying to push higher, so... Yeah, 75 basis points was pretty much a done deal. So if you were to kind of read the statement a little bit more, the committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. So that's their dual mandate. So they raise rates by 3.25%, 4%, so 75 basis points. The committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that's sufficiently restrictive to return inflation to 2% over time. So what they're really saying here, can't get my words out, saying here is that they are anticipating ongoing increases to a level where they become restrictive, right? So actually they believe that they're not restrictive right now, but to get to a level of restrictiveness with monetary policy, they need to keep raising rates, or ongoing rate increases will be appropriate. In determining the pace of future increase in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic financial developments. So I just want to check one thing, though. I want to check something from their last statement. So the committee will continue to reduce its holding of treasury securities and agency debt, and okay. Monitor implications of incoming information for the economic outlook. The committee would be prepared to adjust a sense of monetary policy appropriate if risk emerge that could impede the attainment of the committee's goals. The committee's assessment will take into account the wide range of incoming information, including readings on public health, labor market conditions. So one thing that they seem to have changed in the statement is after a lot of pressure of looking at lagging indicators, they have pretty much mentioned this right here. If you read this, in determining the pace of future increases in the target range, the committee will take into account the cumulative tightening monetary policy, the lags with which monetary policy affects economic activity, and inflation and economic and financial developments. So they're accounting for, because I think Kathy Wood's been very, very loud about it, that they're looking at lagging indicators. I think many people have been on Twitter and on CNBC and a lot of these places. So I think that's really interesting that they are looking at, and they're understanding that, okay, the monetary policy, the measures that they're taking are going to have impact on the economy, but they're going to have it with a lagging effect. They're not going to immediately see the effects of raising rates right away, but instead with a lag. So I think that's something that they have added from their previous meetings, which is, I think, interesting. That could be a little bit of something that the market might be looking at, that, a little bit of a hint that they're aware that they don't want to over tighten and they want to look at some of these cumulative measures before deciding on future rate hikes. Everything else is pretty much the same. So reducing its holding treasury securities and agency debt and agency mortgage-backed securities. Again, they're going to be doing that closer to $85, $95 billion per month, depending on when the maturities are. MBS doesn't mature for like another 10 years. So unless, of course, they're willing to take a hit on their portfolio and sell them actively, they're going to have to wait. Most of the maturities are going to be for the treasuries, the U.S. treasuries. So, and that's pretty much it, right? So $60 billion per month in treasuries, and then $35 billion in MBS, and total for $95 billion per month. So that pretty much wraps up the statement. That's that is what it was. Markets pushing higher, a little bit of an addition for the lagging effects of monetary policy, and then 75 basis points is pretty much locked in for this month. And now December is going to be in focus now, and what we're going to hear from Jerome Powell shortly. Yeah, they can increase forever. So Fed meetings are always fun. Just booked 20,000. Okay, that's great. Awesome. Congratulations. And Fed comment, hikes appropriate to reach sufficiently restrictive policy equals 50 basis points possibly in December, future data permitting. Yeah, so I think the guidance is what's really going to drive the markets. Let's just take a look at whether these predictions have changed for now the December meeting. So now the next meeting is in 41 days. Let's see what the expectations are. Because now we're sitting at 3.75 to 4%. And I'm really curious to see what these expectations are going to look like. I don't know if it's going to show up though. Like, okay, there we go. So, okay, it's not showing up. Right now it's still 94% for 3.75 to 4%. That's where we are right now. For probabilities, maybe not. I'm not too sure. Okay, so right now we're still pegged for 50 basis points. So 56% probability for 50 basis points, and then 41% probability for 75. You see, the thing is that there's going to be a bigger and more important debate for the December meeting between 50 and 75 as opposed to 50 and 25. Like if you are going to be, so I think the two most dominant potential candidates for rate hikes are going to be 50 and 75 instead of 50 and 25. I don't think anybody's expecting them to go down to 25 for December. Of course, that could change over time, over the next 41 days, but I think there's going to be a bigger discussion whether the Fed does 50 or 75 for December, and where we're going to end up like at the end of this year. Either way, we're still getting up to 5% by next year. I think that's going to happen, and that is going to be a level kind of in line with 2007, right? So just right before the Great Recession, and of course the housing bubble burst, February of 2007, March, April, May of 2007. So it's going to be very comparable to those time periods. So we're seeing a little bit of rotation back down for the market. So, really what happened for the markets really was nothing. I think the markets were down slightly. They went higher. We saw some green candles, and now we're flat. The Nasdaq's only up 8 basis points. S&P is up 37, and the Dow is up 78. So I don't think that really changed anything. It was mostly like a flat sort of reaction because we were already red. We went up a little bit and then we're coming back down. So we're just like, flat on the day. And now it all comes down to Jerome Powell and what he ends up doing. It's all up to him. to see. Well, now I hear the sirens again. So. Oh, actually, literally just said it. The ambulance will be back in 30 minutes. Just filling up for gas. I love it, and it's back. It is literally back. It's early, but it's back. So, Caddy, do you know when the next summary of economic projections is? Yes. So, if you come over to this. That is loud. That is loud. Oof, that is loud. What the hell is going on? Okay. So, yes, the next SEP is going to be due in December. So, December 13 and 14 is when the next summary of economic projections come out. And again, everything that you see with an asterisk, that's the SEP, right? So it says right here, asterisk means meeting associated with the SEP, summary of economic projections. So that's when the next one is going to come out. And, the last time we got that was in September. So these are the projection materials. And, they were expecting interest rates to be somewhere around 4.4% by 2022, by year end. So that simply means another 50 basis points for December. Right? Okay, so that's pretty much penciled in. So that's from their SEP. If they do 75, that's going to be a big shocker for the market. If they do 25, that's also going to be a big shocker. So 50 basis points is what's penciled in from their SEP for December. And the next one comes out in December 13th and 14th. That's a Fed 911 call. All right, let's take a look at the Fed here. Oh, shit. Well, hopefully I didn't shut off the live stream here. Okay. Is everything still working well? I just want to make sure. Just give me a thumbs up if the audio of the video is working well. I just want to make sure that I didn't accidentally just cut off the live stream here. Is it still working? Okay. All right, because I just went back. I'm sorry. But what was the question here? What was I looking at? Yeah, so volatility. Let's take a look at the VIX. So VIX is now back in the green. So 25, 26 levels is where we are at the moment. So, obviously it's been selling off quite a bit. And in 15 minutes, Jerome Powell comes out, by the way. So obviously it's been selling off. So any type of spike during midterm elections or the Fed meeting today or earnings next week or this week can obviously result in some potential pullbacks here for the markets. XBI, biotech is now up 2% right now. So after the big spike that we got, I feel like lots of stocks here definitely started moving. So let's just run through our entire watch list. Let's see what's actually moving here. SoFi is down 7.7%. So SoFi, after the earnings, has unfortunately given up on most of those gains, like 2 back-to-back really brutal red candles. For SoFi. So, from its peak of yesterday, it's, dropped about 19-20%. Definitely a lot of profit taking for SoFi, unfortunately. And then if you take a look at, let's see. So CRL pushing higher. We talked about this during our market open. LABU is on the move. We got JD.com pushing higher. CVS reported earnings, I think, earlier today. So there we go. We got a nice beat on both earnings and revenue, pushing up 5% back over to $99. DraftKings, Coinbase reports tomorrow. And then again, lots of stocks pushing up 1.5%, close to 2%, 2.5%, 3% on the day. With big tech also recovering for the most part, but lots of stocks are still down. Tesla's still pretty much giving up on the gains here. Yeah, Tesla's giving up down again 1.82%. All right, so 13 minutes, and then I'm gonna shut up and we'll listen to Jerome Powell, because I think that's he's gonna be the man of the hour. He's gonna move the markets. We'll do an audio check here shortly. Oh, here, let me just cancel that. Here, let me just put on the do not disturb. There we go. Okay. See, I use WhatsApp too every day. So SoFi fair value, I'm still yet to, well, actually, we've done it from a market price to sales multiple standpoint, but we haven't quite analyzed the earnings or the cash flows because the company doesn't have that yet, unfortunately. So, if and when SoFi becomes profitable and has positive free cash flow, then we'll start to look into that as well. But right now, we just don't have that fair value. So 4.6% for 2023 and 3.9% for 2024. Does that mean the end of those years or just some point in that year? That means for the most part is end of those years. So they're pretty much suggesting that, by the end of 2022, we're going to be at 4.4%. By the end of 2023, we're going to be at that level. 2024, we're going to be at that level. So that's what they're suggesting. Yeah, I'm pretty sure that's what it is. Or it could also be like the peak of that year. But I'm pretty positive that is towards the end, because if you think about 2022, that's what they're referring to from the interest rate standpoint. Guys, make sure that you drop a like. We have over 1,000 people watching, so thank you so much. I really appreciate you guys joining in. We've got Jerome Powell in now literally like 10 minutes or so. So make sure that you drop a like, and of course subscribe to the channel if you haven't already. We'll do like an audio check here just in a few minutes, just to make sure that it's working well, there's no issues, and then we're good to go. And we have talked about a lot of things. So we talked about the probability meetings. We talked about what interest rates could look like moving forward. Of course, we talked about some of the forward P multiples for a lot of these companies that have just been selling off aggressively. We've talked about the pace of this rate hike, and to give you some perspective where we are versus where we've been in the past. Right now, we're kind of leveling with the January of 08 level in terms of rates at 4%. And the higher we go, if you get up to 4.4, which is what the expectation is by the end of this year, we're going to be in November of 07. So now we're going to be getting up to like, what is that, 15 years in the past. That's going to be the same rate. And we're going there twice as fast because this rate hike obviously happened over 2 years. Now we're going up to those levels in under 10 months. And this was the press release, again, from the previous meeting. And then today's we already broke down. So, all right. We'll see what Jerome Powell has for us. And the Q&A, I'm really expecting some good questions from the press, like some really interesting questions about recession, about pivoting, about interest rate hikes, about the guidances, over tightening. Like there should be some good questions from the Fed. What would be your question? Like if you were to ask a question to Jerome Powell, what would be your questions? And again, all jokes aside, I want serious questions. But yeah, Kevin, they never ask good questions. I think who asks great questions? The Senate. The Senate, when they have those Congress meetings, oh man, they grill Jerome Powell and Janet Yellen. Like every time they ask those questions, those are some like really, really intense questions. But yeah, the press really doesn't do like a great job. Some of them are just like a waste of a question. Like some of them, I've heard like some of the craziest questions, and there's such a waste of a question. But hey, we got to deal with what we got to do. So when pivot? When can we expect a pivot? Yeah. So a 3% rate hike at once, Danny says. Oof, that would be catastrophic for the market, man. Like that would be really bad for the economy. Like 3% in one rate hike is like, you do 300 divided by 25. That's 12 rate hikes in one meeting. That's insane. That would be a lot, to be honest. So, Katia, so why did stocks jump after announcement? I think it was mostly due to just getting what we were expecting, 75 basis points, and then that little bit of a paragraph. I think market might have read a little bit too much into that, which is kind of they're going to look into some of the lagging indicators as well, and then they might have, the market might have understood that that's going to that's going to result in them understanding that they don't want to over tighten with the interest rates. I bring it back to why did he stick with inflation as transitory, Oscar? Kind of going back to the old days of transitory. Man, transitory now, that word even just seems like a million years ago, but it was like up until I think earlier this year, I think last year, I think December was when they kind of retired that term, but it's kind of like last year. 3% would trip the circuit breakers. Absolutely. I think that would be crazy. Like 12 rate hikes in one single day. Absolutely. So why he is paying so much attention to unemployment data as well as rent when they are in fact lagging indicators to decide rate hikes? Yeah, that's a great question, and that's exactly what some of the criticism has been. Pretty appropriate because we've got about 7 minutes left. And what's really interesting is that I think Josh Brown said it on CNBC the other day. Not the other day, but like it's been a while. But he basically mentioned that Paul Volcker times and even in the 1970s and 80s, there was no Fed meetings, there was no speeches, there was no Q&A, right? It was just the Fed was like, God, what is going on in Italy here? What is going on? Is this like a regular Wednesday night or is this like every night? I'm not by the hospital. No, I'm not. I don't even know if it's pretty common here, if it's like an everyday thing. So, just seems like New York City all over again. But as I was saying, I forgot what I was saying, to be honest. Yeah, he was talking about the Fed speeches really became more prominent like in like several like in the last few years, where people started paying attention to what Jerome Powell is saying, what the Federal Reserve is saying. Before it was nothing, right? And I think communication is an important tool. Like it's really useful for the markets to gauge what Jerome Powell, what the Fed is doing, but it can also backfire sometimes because. Okay, go on. It's not too loud for us. Okay, perfect. All right, so we got, about 6 minutes, under 6 minutes left for Powell to start talking. As soon as he starts talking, I will be doing a quick quality audio check, and then we should be all set. Yeah, 10-year yields under 4%. Yeah, 10-year yield's been selling off quite a bit. Well, actually, it's back over 4%. So it's more really stabilized here. And that's what the markets have done. Like, really, we were just like down in red, and then we started pushing higher. Right now, we're a little bit green, slightly green. But now all eyes and ears are going to be on Jerome Powell here shortly. Albert says, waiting for the Powell pump. Okay, my voice is a lot louder than that. That's good. Yeah, the yields, we've talked about the gilts and the 10 years and all those things. The spreads are still negative. So, 10-year versus 3-month is negative. It's actually down. And 10 versus 2-year is also negative, down about, 45 basis points negative. And then we got the 30-year and the 10-year also negative right now. Actually, not negative. It was negative, but right now it's pushing higher. Scary sirens is not good for the markets. Well, we'll find out in 3 minutes. It's not a lot of time left, folks. 3 minutes. We've already done our poll. I think most people are expecting Jerome Powell to be hawkish today. So Dan, you're in Turin, right? You're going to Juventus tonight? Well, that's the plan. We'll see if it works out. So that is the plan. 2.5 minutes. 2.5 minutes. I really want to keep the charts over on. I'm going to do it something like this. So definitely want to keep it on the NASDAQ. So this is going to be the NASDAQ. We'll keep the S&P 500 over here. And we'll keep, well, this is going to be covered. We'll just keep the yields down over here. This is going to be kind of blocked by my face as well. But should be fine for the most part. Sandeep, how does it feel like looking at your own video and hearing your own voice? Yeah, it just felt a little weird when I was first getting started, but now it's pretty normal. It's not a big thing now. All right, minute 30, NASDAQ's pumping. We're kind of reaching out to 11,000 here. We're like almost at 11,000. We're like at 64 basis points in the green. We've got the S&P pushing higher. We got the Dow also higher, and the 10-year yields are rotating back down a little bit. Lots of individual stocks are pushing through. You know, Google's back over 90. Tesla's starting to recover a little bit after kind of testing its 21 EMA, I think it is. Yep, so 21 EMA. AMD's up over 4% now, and Apple's also powering through, back over 151. So this is it. Let's do this. 1 minute left. Full of the green candles. Yeah, that's what we're seeing right now is lots of green candles. See, NASDAQ's just kind of pumping right now. It's like everybody just kind of waiting. It's like Jerome Powell's like in the tunnel, you know? It's like during a fight or like during a game or something. Like he's in the tunnel, just like ready. Gotta go out there, answer all the questions, and we'll see what happens to the market. All right, let's see when they actually start here. I'm going to do the audio check as soon as it begins, so let me know, you guys, if the audio is good. All right, I'm gonna this one I think is already working. So I'm gonna do an audio check as soon as this thing starts playing now. As soon as he comes on and starts talking, I'm gonna shut up and then do an audio check. You guys let me know if it's good. I just want to make sure if it's not too loud, not too low, if it's good, and then we'll be all set. All right, there we go. I'm gonna shut up. Just give me a thumbs up if the audio is good, okay? I'll adjust.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. we are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs, and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Colby. Thank you, Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So, what I want to do is put that question of pace in the context of our broader tightening program, if I may, and to talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate, given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement. Because that really does become the important question we think now is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restricted, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember though that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick Tamaros of the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high fours, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward, a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people who publish an assessment of underlying inflation.
Thank you.
Hi, Chair Powell. Thank you for taking our questions. Gina Smiley, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter term inflation expectations moved up between the last meeting and this meeting. And we don't think those are as indicative, but they may be important in the wage setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we have, we're now 18 months into this episode of high inflation, and we don't have, a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is, it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And, the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do? And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing that I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them, but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say that.
All right, everyone. So as I said earlier, I do have to run. I did share the link for the ongoing stream so you can continue watching, but I do apologize for cutting this a little short. I have to be somewhere, so I have to get going. I really do appreciate you guys. And again, you can continue watching the stream. I shared the link in our Discord, so you can check that out over there. Thank you so much for joining. Markets are selling off, obviously. I'll dissect everything and I'll do like an update video shortly thereafter. So hope you guys have a great day. As always, happy investing. I'll see you guys in the next live stream. Take